Hi everyone, I'm Jeremy.
And I'm Damien.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experience from over 20 years in the game, so you skip the mistakes we made and go straight to property investment success.
And today we will be discussing cash flow and return for an investment property. And this follows from episode 11, how much do you need to get started in property investing?
Yeah, so after you've bought, then what are your considerations? In fact, even just doing your feasibility, what's your return on investment? So yeah, let's look at that.
I think obviously the deposit is the first thing, trying to build up towards that deposit. So we'll discuss a little bit on that. And then also we'll work through a spreadsheet that I've had for a very long time. And
yeah, so just a heads up there for listeners, we do have some visual aids here.
Mm-hmm.
Damo's going to take us through a spreadsheet. So if you get a chance to watch it on YouTube, that would help.
And I think strategy is a key part of this. Obviously lending, but obviously taking into your life circumstances. And we'll do future episodes on this. But things about any future planning. Are you planning on taking time off work? Is there private schooling for kids? Are you planning on starting a family, big holidays, whatever it might be? So it's great that you want to go buy an investment property, but the last thing you want to do is be left with no cash. And then you've got all these other future expenses that are going to follow.
Yeah, you don't want it to be a strain on your life.
Correct. So that's why I think strategy is the key thing, but obviously then lending after that. So strategy is the first step, then the lending component afterwards. Okay. So how about strategies for saving and budgeting to afford an investment property? So I think, I'm going to share the screen here. So if we can, let's just have a look over here. What
this
do we
is
got?
the whiz-bang spreadsheet, is it?
No, this is the one that we did for our CPA presentation. So the way I like to look at it is you've got fixed costs and then you've got variable costs. So this is just an example that I've got on the screen with some numbers that I've just added in there. But for me, when you look at, I guess, a strategy, it's understanding, okay, well, where are there gaps where you can decrease costs? So one might be dining out and takeaway as an example. Over here we've got, this example couple spending $300 a week. Can that be cut back to increase that surplus cash flow? Another one could be we've got a holiday budget of $10,000 per year. Can that be reduced to increase our surplus? Because I guess from all of this, what we do is we want to understand what is our, total expenses. And then again, I won't share it in this podcast, but it's like income, expenses, what is left over, what is that surplus every month? So if we need to find that little bit of extra money, how do you do it? And the first thing is review your expenses. And I find expenses another one, but even like car leases are a huge one. That impacts your lending and it also impacts your cash flow. So I think a lot of people think, grab a car lease, it benefits me through employment. But then you have to think about, okay, well, the depreciation of the car, is there a lease payout after that 4 to 5 year period? So there's a lot of variables to it, but I think what is your surplus is the key.
Yeah, once you know that surplus, then you can plan.
Because if you're only saving $500 a month, you're going to put yourself under significant strain if you look to buy an investment property. Different story if you've got a surplus of $5,000 to $10,000, then you've got a lot more breathing space to maybe accumulate a lot faster.
And out of those sort of expenses, like you've spoken to hundreds of clients, what would you say is, say, the top 2 or 3 where people can easily make changes and improve their surplus?
I think dining out is most probably the big one, or maybe groceries, just being a bit tighter, because if you just tap that credit card, you're not limiting your spend. So I think it's just about making sure. I like to have automated payments. So you've got everything for your bills over here. Once a month, it's just consistent. So think of it as provisioning for items through the year. You might have another bucket for your holidays. Not a big fan of overcomplicating it, not having like 10 or 13 or 15 different accounts. I think maybe 2 to 3, maybe one for everyday spending, dining out, another one for bills, and you could have another one for maybe like holidays as an example. Then you got your big bucket, which is your offset money. So I think they're sort of the key things, but just that surplus, because let's say, for example, you got variable income. You might be on commission base, or maybe you're working as a contractor. Work it out over maybe a 12-month period to get an understanding of what your cash flow might be. So let's say you
if
get paid
it's-
commission every 3 months as an example. Well, you know that it's going to come in eventually, so you just smooth that out over that 12-month period.
Right. Yeah.
Similar to your expenses, you're on a holiday, let's say it's $10,000, you want to, I like to sort of provision that for the year instead of having that come out as a lump sum. All right?
Yeah. So if you've got a $8,000 plan, or well, let's make the numbers easy, 12,000, then it means if you're going to spend $12,000 on your holiday, you are putting away $1,000 each month. You're not just coming up with a big $12,000 bill in the month of your holiday.
Yeah, that's right. You just want to make sure that that provision's always there. So let's, but I think, holidays and takeaways are probably the big ones.
Right.
Cars also, I think that the car leases, you'd be surprised how many people are on the car leases, and it impacts your lending. So it's just something to keep in the back of your mind before you build out your portfolio, that what is going to hold you back from your borrowing capacity.
Yeah, I think a car is probably the biggest liability that people in the Western world take on. It decreases in value, depreciates really quickly, generates expenses like maintenance and petrol and insurance and rego. It's something you really want to limit, isn't it?
I think another thing too is maybe, like as an example, like phone plans. I used to be on phone plans all the time, but there's nothing wrong like with the iPhone. I'm happy to have it, 3, 4, 5 years. It doesn't, like, as long as it's working fine. And then you can move to like a prepaid, so you can prepay for 12 months depending on the provider that you're with. But you can get prepaid plans for a year for $120 for a year. So if you're not using your phone much, you can save. There's potentially $1,000 saving there every year. Another one is takeaway and holidays, which I've mentioned. Barbershop. Yeah, I went to the barber. It went up to $45, and I've just switched for $25. Like, it's just. So there's obviously a lot of supply of barbershops in my area. So obviously the haircut, you want it to be good, but the price is a factor too, isn't it?
Yeah. What's important to me is that I can just close my eyes and
relax.
Don't talk.
Just relax. So let's move over to, analysing a property. So, or the cash flows of a property. So let me, I guess there's a couple ways. So I know really popular with a lot of companies is they'll use the Summersoft tool. So what it is, it's a property investment analysis tool. Okay. So I'll bring it up on the screen. I think they've got like a yearly fee, but this is it here, PIA software. Okay. You can sort of subscribe to it, but all it is really plugging in numbers. And I'll give an example here where it can be used as a bit of a sales tactic, can't it? Because you can factor in really any growth rate that you like. So it's like, hey, your property's going to grow by this much. It looks fantastic. But all it is just potential cash flows of a property and capital growth. It's all forecasting. That's it.
Yeah. The reason why I haven't looked at these tools much in the past is because you really do need to know what that capital growth rate is in order to come up with an accurate return on investment. Like whenever I have drawn up the spreadsheets like this on my own, I'm trying to figure out where's the best place to put my money. I want the biggest return on my investment for a reasonably low risk. And if you don't know that capital growth rate, then really you can't estimate. But it's good from a cash flow perspective. You put in all the figures, from a cash flow perspective where you're at. So it's definitely helpful.
And you know where the yields are in specific areas. So let's say your cash flows are really tight. Okay, well, I know I need a rental yield of 5% or more as an example. But then that yield might get impacted potentially if it's in a high rise or there's strata, so your net yield's going to be impacted by that. And that's very hard to gauge that net yield because it's going to be different everywhere, isn't it? Depending on the council rates is most probably, there could be flooding.
Council rates, insurance, they can vary dramatically. But I've heard a lot of people say, cash flow is the ants pants because at least if you're speculating about growth, but we know we can rent this property for $500 a week. But you don't know what the vacancy rate is going to be in the future unless you are monitoring supply and demand of rental accommodation in that area. So you can get vacancy rates. And I've had a property before where, rental yield was fine whilst there was a tenant. And then I couldn't get a tenant for like 6 to 8 weeks, something like that. And that really chewed into my calculations of cash flow for that property.
Well, that's just factoring in an occupancy rate into your cash flow numbers.
But it can change, is my point.
That's it.
So there's no certainty. All you know is what you know right now. But forecasting is very difficult.
Okay, so let me bring up like a PDF example. So for example, all it is you plug in assumptions, and for example, we've got a value of 570 there as an example. You've got an initial investment, yield numbers, net yield. So these are just pretty much estimates that you can plug into Summersoft and it spits out this report. And there's, I think, examples that you can sort of see, but the whole idea is it gives you like an after-tax cash flow. So it can be a little bit, maybe a bit overwhelming if you're not into the numbers so much. But I think the key thing is you can factor in this forecasted growth rate, which is, I think, what I really want to be looking at, because you can see after 10 years it's going to be worth 1.03 million. So as a company that might be showing these type of reports, it's going to look fantastic, isn't it? But for me, it's a matter of to keep the buyer's agent accountable. Is it performing the way that it should be? And really what you want is it needs to be outperforming the national average. If I'm paying someone a fee, that's what they need to be beating. No?
Yeah, and that example you've got there, was it 6%? Capital growth?
Yeah, it's got 6.1%.
So that is pretty close to the long-term national average, at least over the last 30, 35 years.
But what I want to, I guess, move over is to my whiz-bang spreadsheet that I've got. So let's work on, I guess, a couple different scenarios. So we mentioned in episode 11 that deposit of roughly, let's call it 26%, for deposit and purchase cost of 6%. So, for example, let's say we're purchasing that $400,000 property. This is the cash or equity potentially required to fund that purchase. So we're injecting, let's say, $100,000, and what we want to understand is what is our return on investment for that $100,000.
Yeah, so we've invested $100,000 plus $24,000 in other additional entry costs.
Well, that's included, sorry. So it should be that $80,000, which is a 20%,
80,000.
and then the $24,000 is like those closing costs that I use 6% as maybe that rule of thumb. Could be a little bit lower, but like I said, we've got a little bit more in there for maybe like renovations, or potentially if you do a buyer's agent, use a buyer's agent on it. All right. So all up, like if you're buying that $400,000 property, it's going to cost you that little bit more due to those extra purchase costs. Okay, and I guess that's the hardest thing with flipping properties potentially, is that buying in and out is really difficult. Like you're trying to do these value adds and you're trying to flip, you really need that capital growth to do the heavy lifting. And I know there was one example, I had a client, and I think he did it in Victoria. He thought he did really well because he made I think it was like 10% or something, but it was actually the growth of the area that did the heavy lifting, not the amount of money and the renovations that he did to the property, which was...
Yeah, I've done the same thing. And when I was a noob investor, I thought the renos that I did added value. I had a delayed project and it took me like a year. But what happened is I'd purchased a property in the middle of a boom, and I really don't know what the influence of the value add was really. It could have just all been natural capital growth, and that would have been great, just sitting on my hands rather than sanding and meeting with tradies and getting quotes.
But it shows you how important, I guess, that capital growth is early on. So obviously when you're getting into a market, you want to get that uplift and that equity as soon as possible. And I know we're going to do future podcasts about do you hold, trading, and different types of strategies in the future. So that'll be exciting later on in the year. But okay, so we've got the purchase price, and then what we want to understand is cash flow. So let's just say we're using a rental return of 4.5% rent return. So the rental yield is pretty much that number, 4.5%. So on 400,000, that works out to be $18,000 that you receive in rent per annum from your tenant.
So that's what, 1,500 a month?
Roughly correct.
Yeah.
All right. And
so
then
about $400 a week.
Yeah, if we just do it, what's that work out to be? 1,500, correct, a month. And then if we move over to the rental income on the left-hand side, I've used an occupancy rate. So let's just say 2 weeks of the year, there's no tenant in the property.
Right. Yeah. Vacant.
Just obviously areas you invest in, you want the vacancy rates to be really low, not in that specific suburb alone, but those surrounding pockets also. Typically where you might see higher vacancy rates is high-rise units. I remember back in around COVID, around Docklands and all of that skyrocketed. Inner city units around there, also the vacancy rates skyrocketed.
It's almost always a case of oversupply.
Yeah. But a lot of oversupply is being absorbed at the moment.
Yeah. Well, gee, try and find a market with a vacancy rate above 2%. They're quite special now, whereas 2% is like the long-term norm.
And then you've got rental income. So we've got rental income of, let's say, 17,280 once we factor the occupancy. So that's a rent coming in. But then what we want to understand is what are our annual expenses? How much is this property costing us? Because think of it as like a business. Money in, money out, what's left over. Now, I've just factored in 7% for that interest rate. I know the long term sits around, 5 to 7%, but let's just be conservative with this. Because typically you might hear someone say, I want a positive cash flow property from the get-go. But even if you buy it that $400,000 mark, it might be quite difficult to get that cash flow.
Yeah, it makes sense too. If a tenant could afford the cash flow to purchase a property, then they would. So, yeah, it makes sense that properties are usually negatively geared.
Now, we've got like loan repayments at 7%. So that's our biggest cost. And that's most probably our biggest variable, isn't it? When interest rates were, let's say, 3%, you can see right away your repayments drop significantly.
Yeah, that's amazing though.
So from 22,000, if we brought it back to 3%, what it was maybe a year and a half ago, 9.6. So you can see the biggest impact is that loan repayment and controlling that. Things like council rates, it's going to vary. You got maintenance, you maybe got insurances, maybe management fees. You might have land tax component if you've got a big portfolio. So land tax is depending on if you've got a lot of properties in, let's say, New South Wales, or they would calculate the land value. I think they do. Is it every 3 to 4 years they calculate the land values? You get the letter saying.
Yeah, the bill shock usually.
There's thresholds. And maybe we can do a future episode on the land tax, but that does impact your cash flows. So it's something that you need to be aware of. But yeah, like maintenance might be more. Like you can obviously increase some of these components, but again, factoring that higher interest rate hopefully should absorb that. And then what we want to understand is, okay, well, what is the annual cash flow for this specific asset? So it's costing us close to what, maybe a $10,000 deficit per year. Okay?
Right.
10,000, and then we receive a tax credit of about 3,600. So even though it's cost us 10,000, there's a negative gearing component where we've accumulated more losses. Based on your, tax, it reduces how much tax you have to pay. So an example would be you earn $100,000 a year, your taxable income would be reduced by that 10,000 or that 9,966.
So you're only paying tax on a salary of 90,000, not 100,000.
And they work that out at the end of the year. So you submit everything to your tax accountant, and then they'd be like, okay, there's a negative gearing component here, and then you might receive more money back depending on how much PAYG that you've paid throughout the year or tax you paid.
And, there's a lot of news in the media every now and then about negative gearing, but this is common to any kind of investment or business. You claim the expenses against the income. So if you had bought some shares and you borrowed money to purchase those shares, you can claim the interest as a tax deduction.
Again, you need to talk to your tax accountant, because I have heard things like, is the share portfolio generating any income? Like if it's just growth assets,
dividends.
And then you'd have to sort of separate it as a new equity release. So again, you need to talk to your broker and your tax accountant about that. But I have heard that, if you're buying specific index funds or yield type of shares, then that portion of the loan could be tax deductible. So an example would be, I'm releasing $50,000 out of my equity out of my property, and I'm only going to purely use that $50,000 for income producing shares potentially.
Yeah.
As an example, like A200 index fund, top 200 companies in Australia.
Yeah, but the point is that negative gearing is just a term used with property investors, but the same tax scheme is applicable for share investors, business owners. If you've got a barbershop you claim expenses as a deduction.
And that's the argument where I know that it's, you hear cash flow, I don't want the property to cost me anything, and I get it. But I think you just need to make sure or ensure that you are getting that capital growth, which can happen. You can get that cash flow and also get that growth behind it. So the annual cash flow will drop down to around $6,200. So it's still costing us out of pocket about $121 after tax. So we still need to find that.
A week,
Correct.
after tax, yeah.
After tax.
All right.
So it comes back to my example. If my surplus is only $5,000 per year, I can't even afford a $400,000. So my lifestyle needs to change. And that's the first step that I see all the time is sort out your cash flows first, then go to a broker. Don't go to a broker first and go, I want to buy a property. What can you move? What levers have you got?
Good one.
All right.
Yeah.
And then we've got, what have we got? So cash on cash returns. So obviously it's a negative number due to the fact that we're in a negative cash flow position. But where the key here is capital growth. And all we're doing is really speculating, aren't we?
Well, with all of these sort of software, you have to put in the figure. So you need to know. And the average investor has got no idea what the growth is going to be.
I remember clients coming in and they've seen, like they've brought in brochures where off the plan unit in Queensland somewhere or New South Wales or wherever it might be, and they have like 7 or 8% capital growth per annum. I'm like, no,
Off the plan.
And then the valuation would come in under what they signed up for.
Yeah.
But I think it's there's a lot of content out there now where there's a lot of knowledge around brand new versus established, a lot of podcasts out there and a lot of education, which is great.
Yeah, it used to be shiny brochure from the developer. The investors would lap it up. But we're getting better educated about how new property underperforms.
Well, it could actually, back to that case of expenses, one thing I didn't touch on is maybe depreciation. So the way that a lot of these off-the-plan companies might work is, you might get $15,000 deductions extra per annum as an example, and that puts you straight into the positive.
Yeah,
so it's a tax
yeah.
benefit that you get, but what they're not telling you is that asset is actually depreciating over time, and your land component is nothing.
Yeah, that's right. That $15,000 that you would claim is real loss in value of the property due to aging. And you although you claim $15,000, you don't get $15,000 back in tax. You get a portion of it back. So you're still worse off. If you claim $15,000 in deductions, you might get a $5,000 benefit from that. But you're not better off by $15,000. You're actually worse off by $10,000.
That's right.
The value of the property's gone down. You've reduced that loss. That's all.
What's it cost, isn't it? Because it's like 15,000 times your tax rate. I'm using 37% here as an example, but by adding that depreciation in, it does. And look, I get it. It's not going to cost me anything. Fantastic. Where do I sign?
Yeah, that's right.
But where it does hurt is the assets going down in value, and they realise it later because they're not getting the capital growth that they need to accumulate and release equity into the future.
Yeah. I think that a lot of investors have been lured by those shiny brochures. Everything's new here. It looks like a great property. And I think that's why investors over the long term have underperformed the national growth ratings, because too many of them are buying new.
And we've got, let's say we did factor in 5.5% growth. So on 400,000, just for the first year, it's 22,000 as an example for that first year. But you'll see we've got a negative cash flow of about 6,000 per annum. But in estimated growth, this is the key I'm okay with a property costing me as long as I'm getting that optimal growth.
Makes such a difference, the growth.
The difference through if the yield's really low and it's really impacting my life, that's one thing that you don't want.
Sure.
It shouldn't impact your lifestyle, but you need to have that bucket there. And it's normally early on, I find, in that accumulation phase where you might have that negative gearing. But that estimated growth of 22,000 is what we're really after. So the profit after 12 months is 15,700. So the net profit, or I'd say return on investment, is about 15%. And that's using some conservative numbers here with that higher interest rate. But 15% on your money, I'm happy with that.
What we're talking about there is pretty much bog standard yield, bog standard interest rate on your mortgage, bog standard capital growth rate. Everything looks really ordinary here, but you're still looking at a 15% return on your investment, which is certainly better than cash in the bank, and probably better than a lot of super funds performance over the long term. So it's still very good return on investment, given it's just a very ordinary property.
And if you go, like, let's say we said the interest rate was 4%, let's have a look at it. So it's the ROI is a lot more now just because it doesn't have that huge cash flow impact. So we've gone up to around 21% return on our investment. So keep it simple, profit. And with that profit of growth, there's no tax associated with that because we haven't sold the property. You'll pay potentially capital gains when you offload that property, and based on current tax law, it'd be at that 50% discount if held for more than 12 months.
Yeah.
Okay.
Yeah, so you do lose a little bit of that net profit, but there are certain purchase or entry costs that you can claim against that. Then you've got your 50% CGT discount. So it's still a pretty good return on investment.
So 15%, but what I want to, I guess, highlight also is I've got, this is just from, I think, the Vanguard index. So I think roughly what the last 30-year capital growth average for property is what, 30, it's about 5.9%, 6% roughly, Jez?
Yeah, around about 6%.
Okay, and then if we have a look at other investments, so this is from 1992, if you had $10,000 invested, okay, and then the Vanguard data assumes no transaction costs or taxes, and all the income is reinvested. So any dividends that you receive, it just goes back into the portfolio, okay? So Australian shares would be worth around 131,000, which is 9.8% return on your investment. You've got US shares around 11.7. That was actually the highest. Australian listed property, 9.3. International, what's this Australian listed property?
Yeah, listed property. So I think they're talking there about real estate investment trusts.
Okay.
They quite often buy commercial, or they'll buy a big block of apartments. And investors invest in that trust. The trust invests in property. So it's listed. So you can buy units on like the ASX.
Then you've got investment, you got international shares, you've got Australian bonds, and then cash is the lowest. But maybe it doesn't consider, does it assumes no transaction? It doesn't even consider the taxes. So I guess we are considering that in our example with the income, aren't we? There.
Yeah, so some of these returns would be lower if you factor in tax.
Correct. Now, so let's just use the 11.7 for maybe the US shares, or maybe simple Australian stock market, about 9.8. So if we round it to 10% per annum, where with a property, we're aiming for, obviously with a lower interest rate, hopefully closer to 20, but in this conservative example, we're looking at 15.
Yeah, there's a big gap there.
Big gap, but I guess with shares, you've got a lot more liquidity. It's not going to put you in a negative cash flow territory. With property, your money's locked in. So I'm a big fan of maybe allocating assets like more towards obviously property, but there's nothing wrong with having a bit of shares if you want a bit of that diversity in cash flow.
Yeah, liquidity I think is the big one, isn't it? You can't sell part of your property. But if you're after the big returns, property's the big deal. But of course you need to save up, in this example, a big deposit. For this case, it was $80,000, wasn't it?
Well, close to 100 if you include all the transaction costs. So 100,000. But if you've already got an existing property, you go to a broker, you release equity, and you can get in a lot sooner if you can get the serviceability. Okay.
Yeah, so maybe shares is a good thing to start off with $10,000, $20,000. But once you've got the savings, you really want to get into property.
Well, it just depends. If you're looking for that first property, I guess you could have that fluctuation in the share market. So if my goal is to go buy that investment property, I would most probably just keep it maybe in cash and try and build it up as quick as possible, because there is a risk of investing in stocks that I am going to get that dip. I still want to take a long-term horizon in the stock market also. Even though it's invested within my super, there's shares and all that within our super funds, index funds and managed funds, but I think it just depends. All right. The other one is, let's say we went to 88%. So again, using that 400,000 example, This
Right.
is
So when you say 88%, we're talking about the loan to value ratio. So we're
Correct.
contributing a smaller deposit.
So back from episode 11, remember how we factored in that if we used 88%, we don't need to come up with as much cash, but then there's a lender's mortgage insurance premium associated. So you can go back to episode 11 to get a bit more insight on lender's mortgage insurance. But that's the whole idea. So we're coming up with a lower deposit. So 72,000 compared to that 104 in the first example. Now, this is where we mentioned that, okay, you're going to have other costs, which is that lender's mortgage insurance premium that I've factored into the spreadsheet. So your loan's going to be, they normally capitalise it in the loan. They capitalise it in the loan, so your interest is going to be slightly more. All right. So if we have a look. So if I'm only saving $3,000 a month, like actually $3,000 is a lot, but let's say you're saving $3,000 a month, it's going to take me, another 10 months to try and come up with that deposit. So lender's mortgage insurance you can utilise to get into the market a lot sooner through that accumulation phase.
Right. So you're not chasing the market. Yeah, you get in early.
You get in early. And then if we move down, you can see how the ROI is a lot more now. So we've jumped up to 19.6. So even though the profit is lower, let's say 14,000 compared to our 15,700. Why is our ROI better?
Because we've put less in.
We've put less in. So instead of coming up with that 104, we've injected 72. So our return on that 72,000 is around that $14,000 mark, which is around 19.6.
Yeah, so simply choosing to pay lender's mortgage insurance, you've increased your return on investment from around 15% to over 19, close to 20.
But it also, as I've mentioned, allows you to have that buffer. So let's say I save that 100,000. I don't want to put all that money in and then I'll lose my job, or there's risk of losing my job, or there's something coming up, or I need to buy a car, whatever it might be. You still want to keep a little bit of a buffer behind you. So that's why I think LMI is something that you should always talk to a broker and consider in your investment strategy.
Yeah, not a waste of money at all.
And I guess the other example I wanted to bring up was shares. So like, let's say you did invest that 104,000. This is sort of after tax that I was working off. But like you can see your return is potentially a lot lower, but at least you're not in that negative cash flow. Like every week you're most probably bringing in about $50? Is that right? In cash flow divided by... So it's about $50 coming in. So shares isn't draining me of my surplus. It's actually helping me with cash flow.
Yeah. Yeah. So there is a benefit to it. It's just that the return on investment may not look as attractive, but there are certainly benefits from cash flow perspective and liquidity.
It's the growth and the leverage power of property that's the big one. So where you're receiving maybe growth per annum of around 6,000, with the property it's more around that 22,000. So you've just got a lot more opportunity for that growth in the property market.
Yeah.
Not to say you pick that stock and you have a gamble, but it just all comes down to research and having a bit of a plan in place. And it's not a perfect science. I just think strategy first, lending, lifestyle, all of that together. Because once you buy property, you sort of just forget about it, don't you?
Yeah,
Hopefully.
That's another thing. You just sit on your hands and let time do its thing. Time's on your side then.
All right, just anything to add to that? That was a good one. I think.
It was good. I think it's really an eye-opener about the profitability of property versus other asset classes. And there are benefits to other asset classes, but if you can afford to buy property, it's a bit hard to ignore those sort of return on investment calcs.
Yeah.
Pretty detailed spreadsheet, Damo.
Yeah, I've had that for years, actually. I always sort of come back to it when I just like to analyse. So it's just easy. Like I know that Summersoft, there's nothing wrong with that, but I like, my ones, you just plug in. I've got my input fields and easily done. But I think for me, it's just about always sort of be skeptical. Like if you're going to another firm, ask a lot of questions. And then if you do buy a property, keep the buyer's agent maybe accountable. Like, you're paying them a fee. Is the property performing the way that it should be? Because if I'm paying 15, 20, 25,000, is that property beating the national average? And maybe not over a year, but maybe 3 years I'd expect for a buyer's agent to beat the national average. And if they're not, I'd be very concerned. I'd be asking questions.
Yeah, well, a lot of them will go to that age-old excuse, over the long term, it will outperform. Give it 20 years.
What am I paying you for?
Yeah, well, there's that. And also you can ask them, well, what were you purchasing for your clients 20 years ago? Can I see a list of all of those?
Maybe that's the big one. Like if you go further back, that really does tell the story. And I think there needs to be more of that in the industry and something that we're going to look towards in the future, bringing some accountability.
Yeah, accountability is a big one.
It's everything.
All right. Closing remarks, Tamo?
No, that's it. I just think, just have your cash flows in order. Be skeptical. Ask a lot of questions. Just don't believe someone just because they're, they have a company or a property firm, finance firm. Always ask questions. Ask about, what does your portfolio look like? What have you purchased? But where can listeners go, Jez, for more?
Well, we've got more of these episodes. You can subscribe and they'll appear in your feed. And if you like this sort of content, let us know so that we can produce more of it. So give us a click on like, subscribe, and share to the world.
Thanks for tuning in and see you in our next episode. Bye for now and take care.